I think the prospects for renewed inflation from domestic sources in the Eurozone is very, very low. I think, if you look at, I mean, it's not a coincidence that the ECB's forecasts are every time they might, be a little different in the short run, but they all pretty much show that by the late 2025, they'll be back on target. They also, if you look at the forward-looking wage tracker, indicate that we will see a continued decline in negotiated wages coming into 2025. And therefore, the prospects of inflation rebounding based on wage pressures, even though labor markets remain fairly tight, but since a lot of that is due to labor hoarding, that's actually going, in my opinion, to accelerate the decline of profits in the Eurozone. So unit profit growth will also decline, which means that the combined effect of both wages and profits in the Eurozone will actually go down. So I am, quite, I guess, optimistic or pessimistic, depending on your point of view, but I don't think domestic-driven inflation in the Eurozone is coming back.
What about the prospect of having to accelerate rate cuts next year because they cannot go back-to-back just yet in 2024, but because they are not so fast and furious for the rest of this year, they might have to do a little bit more aggressive. And the second part of the question is, what does that do to the euro? Because I'm looking at one of the most bearish calls on the euro from Morgan Stanley, $1 or $2 per euro.
Yeah, I mean, I think, if they were adequately forward-looking and if they shared what is my general pessimism on the growth outlook in 2025 and 2026, I think they would seriously consider a cut also in October. But as I said, I don't think that will happen. Rather, I think they will need to accelerate. I think the threshold, unfortunately, for a 50 basis point rate cut is still quite high. I think, however, you're going to see a number of back-to-back rate cuts in the first and second quarter of 2025, meaning that we will get down to, the sort of 2.5 or 250 basis point deposit rate level by the second half of next year, which is where we need to start talking about, what is the terminal rate. But yes, the bottom line is they got to have to step on the pedal a little bit come 2025.